All right, let's dive straight into this explainer. If you've been staring at your textbook, completely stressed about your ACC 202 exam, and wondering how on earth you're going to remember all these new rules for AASB 16, take a breath. You are in exactly the right place. We're going to break this massive paradigm shift down, concept by concept, so you can walk into that exam room feeling absolutely bulletproof.
To keep things simple and lower your cognitive load, we've structured our roadmap today into 5 quick sections. Week 6, Mastering Leases, Defining a Lease, the lessee accounting model, exemptions and exceptions, and finally, the lessor accounting model.
So, let's kick things off with Section 1, Week 6, Mastering Leases.
Okay, context is literally everything when you're trying to understand the why behind accounting rules. Why did the standard change in the first place? Well, under the old rules, companies were using this massive loophole to keep operating leases completely off their balance sheets. It basically made them look like they had way less debt than they actually did. IFRS 16 completely slams the door on that off-balance sheet hiding. Now, lessees have to recognize almost all their leases directly on the statement of financial position. And hey, quick exam tip. If you get a theory question on why the standard changed, this right here is your golden ticket. It's all about total transparency and creating a much more faithful representation of a company's actual obligations. No more hiding those massive fleets of aircraft or huge real estate leases.
Moving right along to Section 2, Defining a Lease.
Look, before we can account for anything, we have to know exactly what we're looking at. If you only memorize one definition for your exam, make it this one. A lease is a contract that conveys the right to use an asset for a period of time in exchange for consideration. The absolutely crucial element here is that transfer of the right to use. Basically, the customer has to be the one calling the shots. They get to direct how the asset is used, what its purpose is, and how it operates. If you don't have that level of control, well, you don't have a lease.
And here is the trap your professors absolutely love to test on. I call it the substitution trap. Think about it. If a supplier can just randomly swap out the underlying asset for a different one at any point during your contract, have you genuinely gained the right to a specific identified asset? Nope. Because the supplier holds that substantive right to substitute, the contract is not a lease. Keep your eyes peeled for that specific trick in your multiple choice questions for sure.
All right, on to the main event, Section 3, the lessee accounting model.
Now that we know what a lease actually is, let's tackle the heavy lifting. This is where the core journal entries happen. Under the new standard, for almost all leases over 12 months, you have to do this initial recognition on the balance sheet right at the commencement date. It's actually pretty straightforward. You debit the right of use asset, and you credit the corresponding lease liability. Boom. You're just recognizing that, hey, you have an asset you control, and you have a very real legal obligation to pay for it over time.
But hold on a second. Before we start plugging numbers into that journal entry, what exactly counts as a lease payment? Because honestly, it's almost never just your flat monthly rent.
You might actually want to grab a screenshot of this list right now, because you will absolutely need it when you're doing your practice problems. Your lease liability is officially the present value of these specific unpaid components. You've got your fixed payments, sure, but it also includes variable payments, the ones tied to an index or a rate. It includes amounts you expect to pay under guaranteed residual values, the exercise price of purchase options, but only if you're reasonably certain you'll actually use them, and even termination penalties. You gather all of those up and you discount them using the interest rate implicit in the lease. Now, if that implicit rate is a mystery, which it usually is for lessees, you just use your incremental borrowing rate instead.
So, how do we measure the right of use asset? Well, it's basically a stack. You start with that initial lease liability we just calculated. Then you add any lease payments you made at or before the commencement date, plus any initial direct costs you had to pay to get the lease set up, and finally, any estimated cost to dismantle or restore the asset at the very end. Actually, if this formula looks incredibly familiar, it totally should. Lightbulb moment here. It looks exactly like the initial cost measurement for an item of property, plant, and equipment under AASB 116.
Okay, so what happens in the subsequent periods after day one? Notice how the liability side and the asset side are treated completely differently once they're on the books. They go their separate ways. The lease liability acts just like a bank loan. Every cash payment you make is split between an interest expense, which unwinds your discount, and a principal reduction. The right of use asset, on the other hand, acts like PPE. It just gets depreciated, usually on a straight-line basis, over the shorter of the lease term or the asset's useful life. They do not reduce to zero in the exact same pattern.
Which brings us to this incredibly important reality check.
Because your interest expense is calculated on a declining liability balance, it's super high in year one and shrinks over time. Meanwhile, your depreciation expense stays perfectly constant every single year. When you combine those two, your total lease-related expenses on the income statement will be much higher at the start of the lease and lower at the end. And that's true even though your actual cash payments to the landlord are totally flat. This front-loading effect is a massive deal for a company's profit and loss statement, and I can almost guarantee you'll see a multiple-choice question about it on your exam. It's just too good to pass up.
Let's take a quick breather and move to Section 4, Exemptions and Exceptions. So after all that complex balance sheet math, the standard actually throws lessees a bit of a lifeline. A company can make an accounting policy choice to completely skip that heavy recognition model for two specific categories. Number one, short-term leases. We're talking 12 months or less with absolutely no purchase option. And number two, leases of low-value underlying assets. And this is assessed on an absolute basis, no matter how giant the company is. Think laptops, tablets, or small office furniture. By using these exemptions, you skip the asset and liability recognition entirely, and you literally just record the payments as a straight-line expense over the lease term. Super easy.
Finally, let's flip the script. Section 5, the lessor accounting model.
For the lessors, the actual owners of the assets, things didn't radically change with AASB 16. They still use the classic dual classification model. Basically, they look at a lease contract and ask, does this transfer substantially all the risks and rewards of ownership to the lessee? If the answer is yes, it's a finance lease. If it does not transfer those risks and rewards, it just remains an operating lease.
Now here's a really cool distinction within finance leases that you definitely need to know. It depends on the type of lessor. A financier lessor, like a big bank, just takes the physical asset off their books and sets up a lease receivable for the present value of the payments, earning interest revenue over time. But a manufacturer or dealer lessor, someone who actually built the asset, they recognize an immediate selling profit or loss upfront at the very start of the lease, exactly like a normal sale, alongside that ongoing interest revenue. Oh, and note this down for the exam. Manufacturers and dealers expense their initial direct costs immediately, unlike banks who just add them to the receivable.
And for operating leases, it's an absolute breeze. Because they tip the risks and rewards, the lessor just keeps the underlying asset right there on their own balance sheet. They continue to depreciate it like normal, and they just record those lease receipts as a nice, steady stream of straight-line income over the term of the lease. No complex math required.
All right, you now have the ultimate structural roadmap to go crush those Week 6 practice questions. But as you're studying, I want you to chew on this final thought. Now that companies literally can't hide their massive lease liabilities off balance sheet anymore, how is this new transparency going to alter real-world corporate strategy? I mean, if leasing no longer keeps your debt hidden from investors, are we going to see a massive shift back to companies just buying assets outright? It's a fascinating question that's actively reshaping modern finance. Thanks so much for joining me on this explainer. Study hard, and I will catch you on the next one.